Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today is Friday, March 20th, TGIF. Today, I'd like to talk about oil. The Wall Street Journal took a poll of 50 serious Wall Street economists, and they asked these economists, look, how high does the price of oil have to go for the U.S. to enter a recession? And these economists came back, and the average price was $138 a barrel. And it doesn't just have to touch $138 a barrel. It would have to stay there for an average length of time of 14 weeks. So that is the poll from Wall Street economists. Again, 50 economists at major Wall Street banks. And they're saying, look, if oil hits $138 a barrel and stays there basically for 14 weeks, the U.S. is likely to enter a recession. Now, currently, they put the probability of a recession in the next 12 months at about 32%. So they figure 2/3 chance of recession. But again, this is the way this is going right now. This is how this is looking. And it's really a split screen scenario here for the United States. The bigger concern, on one hand, you have the AI growth, capital spending growth. You have Nvidia CEO Jensen Huang saying they're going to sell $1 trillion worth of these chips through 2027. That's obscene. Basically saying we got orders already, backlog for $1 trillion worth of these things. That means that everybody is building data centers. That is a serious signal for the economy. However, so on that side, there's a lot of growth. There's a lot of mining growth. There's a lot of growth in that kind of infrastructure. On the flip side, on the other side, you have oil, which is more related to this war, this conflict in Iran, basically a 50-year war with Iran. We just finally actually got involved in the war. They've been fighting us for 47 years, that's for sure. We're actually just fighting back. But even before that, and I think something that a lot of economists are missing is really the bigger issue here. It's really the stagflation kind of cycle. That has given me a little bit more concern because the numbers that came out yesterday for stagflation were really not pretty. You're seeing the PPI, the producer price index, and the CPI really well above the Fed's 2% target rate. And the producer price index, the PPI, is important because it is the price that producers, people who make products for us, like computers, let's say, or like glasses, or make like keychains or AirPods or whatever it is, the prices that they're paying to get the materials needed to turn things into AirPods or whatever it is, or glasses cases, those have risen about 3%. And so when the producers end up paying more for their inputs, they pass that cost along to consumers. So when you see producer prices going up as much as they have, then you're likely to see consumer prices going up very, very high too, because again, most producers don't have the margin in their income statement to eat those costs, and they wouldn't even try really to eat those costs. Most producers are going to pass those prices on to consumers. So if producers see an increase, it's like going on an airline. If the airline is paying more for fuel, then you are going to pay a higher airline ticket. That's the bottom line. So I think the serious issue here with inflation, more of an issue because we're flirting with this stagflation economy, which stagflation is that fun word from the 70s. What an ugly word that is, stagflation. Stagflation. Stagnant growth and inflation. And stagnant growth, you're really starting to see these job figures get revised downward. You're starting to see economic growth just really slow down. It seems like it's shifting to a lower gear. And that's happening concurrently while this inflation, these producer prices and then consumer prices seem to be going higher. So we're in that really nasty phase. And I talked about losing the dollar as the world's reserve currency because of debt, because of spending. A lot of that, when you look back at the 70s, a lot of the same dynamics that were in play back in the 70s seem to be repeating themselves right now. But again, it's a little too early to say with any conviction which way it goes. These are just a series of probabilities. It can go left, it can go center, it can go right. The Iran war could be over tomorrow. We can go down and kill the next general, and then some moderate rises up and raises his hand, as we talked about recently, and says, I can do business with you, or it could just escalate. So we are at the mercy of events. We're going to keep an open mind on any scenario that comes around. We're not going to get pigeonholed into calcified thinking, and we're going to play the ball where it is, not where we want it to be. Just see it as it comes. But remember, it's like, don't drink and drive, which in our business means don't be running out and doing crazy speculative things. Bring in your sales a little bit. Take it a little bit easy. We don't have to swing at every pitch that comes across our plate. We want to play it safe with our capital right now until we have a firmer direction. In other words, the market is starting to change. It's in this kind of stuck in this neutral place. You don't know. It has a bias downward now. That can change pretty quickly. So we don't want to marry any bull or bear position. Not quite yet. Anyway, that's all I have. Have a wonderful weekend. I'll see you Monday.